All right, so we're diving into a mountain of IRS documents today
Yeah.
for our deep
Oh,
dive.
it's that time of year.
It is getting ready for that 2024 tax season as an employer.
Employers need to be ready.
Definitely, definitely. And I see right off the bat, the Medicare rate is holding steady
Oh, good.
at 1.45%.
That's nice. A little bit of stability.
It is
Yeah.
for both, the employer and the employee.
Mm,
No wage-based limit there.
which is nice.
Always nice. But okay, what's this about COVID-19 leave credits?
Oh, yeah.
I thought those were long gone.
So technically they have expired,
Okay.
but there's a little twist.
Okay.
If you are still paying out for leave taken
Okay.
before October 2021, you can claim them on Form 941X.
So a 941X, that's like an adjusted quarterly return, right?
Yeah, exactly.
Okay, so that could be a game changer for some employers who are still catching up.
It could.
Yeah.
It's an overlooked detail,
It is.
but it could mean some savings.
Yeah, definitely. And speaking of details,
Oh, right.
did you know that timely mailing still counts as timely filing?
That's right.
Wait, really? So it's not just about that postmark anymore?
It's not if you use an IRS-approved
Rah.
private delivery service.
Oh, okay, so
We're good to go.
like certified or somewhat.
Yeah, think of it as a little extra peace of mind.
Yeah,
Especially when those deadlines are looming.
right.
Yes.
I'm definitely going to look into those approved services. Any other kind of hidden gems or things that we should be aware of?
Well, one thing that caught my eye was the expansion of Spanish language forms.
Oh,
It's
nice.
great to see that,
Yeah.
inclusivity and accessibility.
Yeah, everyone deserves to understand their tax obligations, right?
Right, exactly.
Regardless of what language they speak.
Absolutely.
Okay, cool. So we got Spanish forms.
We do.
We got information on new payroll tax credits for employers, disaster relief options,
Yes.
and even a certification program for PEOs. That's right. Yep.
Wow, there's a lot to unpack.
There is.
Feels like they're throwing a lot of changes at us.
Yeah, always.
But before we get overwhelmed, I think it's time to kind of break down some of this tax jargon.
I think so too.
What do you think?
Let's start with, some of the terms that trip people up.
Yeah.
Like, for instance, the look-back period.
Yes. Look back period, deposit schedules.
Yes.
It all sounds like, a secret code.
It does, but it's pretty straightforward.
Okay.
The look-back period simply refers to, a specific time frame
Okay.
that the IRS uses to determine how often you need to make
Okay.
your federal tax deposits.
So it's not just like a random period of time.
No, not at all.
Like they're looking back on something specific.
They are. It all boils down to how much tax liability
Okay.
you reported in the previous year.
Okay.
Let me give you an example.
Yeah.
Let's say you reported $50,000
Okay.
or less in employment taxes during the look-back period,
Mm-hmm.
which, is typically July 1st to June 30.
Okay.
You would be considered a monthly depositor,
Okay.
but if you reported more than $50,000,
Mm-hmm.
you'd be considered a semi-weekly depositor.
So that's how those deposit schedules are determined by
Okay.
how much you paid in the past.
Exactly.
Okay, so the look back period is really important.
It is.
Okay,
Yeah.
that makes a lot more sense now. So that's really like a litmus test for how often you'll be sending those payments to
I
Uncle
see.
Sam.
Uh-huh.
Okay. Speaking of,
Right.
things that make you nervous,
Yeah.
like payments.
Uh-huh.
The term dishonored payments always makes me a little nervous.
Yeah.
What happens if a payment bounces?
That's definitely something you want to avoid
Yeah.
because dishonored payments can lead to
Oh, yeah.
penalties.
So it's like a double.
It's a double whammy.
Yeah.
Yeah, you're already dealing with the stress of
Yeah.
a bounce payment.
Right.
And then the IRS adds...
Insult to injury. Insult to injury, right?
Right. That's fine. So what's the best way to make sure
Right.
that these payments go through smoothly?
The easiest way, safest way, is through EFTPS.
Okay, EFTTS. Now, I vaguely remember
Yeah.
hearing about this. Can you remind me what it is and why it's so great?
So EFTPS is the Electronic Federal Tax Payment System.
Okay.
It's essentially a free online system
Okay.
provided by the IRS
Uh-huh.
that allows you to make secure tax payments
Okay.
electronically,
Gotcha.
24/7.
Nice.
No more scrambling to the bank
Yeah.
or worrying about postal delays.
Exactly. Exactly. So it's like having a direct line
Did he say that?
to the IRS for all your tax payments.
Uh-huh. It streamlines everything,
Right.
makes it easier for you to stay on top of things
Gotcha.
and avoid those penalties.
Okay, so EFTPS, adding that to my to-do list.
Good idea.
Must have.
Yeah.
Okay. So we talked before about employer responsibilities.
Right.
Obviously, getting those Social Security numbers right is important.
Very important.
What are some other things that, maybe we should be extra careful about?
Well, one area where employers often trip up
Yeah.
is understanding what counts as wages
Uh-huh.
for tax purposes, and it's not always as
Yeah.
clear cut.
You think of wages as just that dollar amount on the paycheck. Right?
Exactly.
But I have a feeling it's a little more nuanced.
It is. It is. Wages encompass a wide range of compensation, including things like bonuses,
Right.
commissions,
Okay.
fringe benefits,
Yeah.
and even the value of meals and lodging
Oh.
provided to employees under certain conditions.
So it's not just about the cash in hand.
It's not.
It's about the whole value of the compensation package.
Exactly.
Okay. Wow. So how do we make sure we're capturing all of that accurately?
The IRS provides a wealth of information on its website, including detailed guidance on,
What constitutes taxable wages?
Okay. Yeah.
And of course, the tax professional can be invaluable
Right.
in navigating those
Yeah.
complexities.
Yeah. Knowledge is power, right, when it
Right.
comes to this stuff.
The more you understand,
Yeah.
the better equipped you'll be.
Okay. All right. So now we mentioned those redesigned Form W-4s earlier.
Yes.
Give me a quick refresh
Sure.
on how those changes impact withholding calculations.
So one of the most significant changes was the elimination of allowances.
Okay.
The new W-4 uses a more straightforward approach,
Okay.
asking employees to provide information about their filing status, dependents, other income deductions directly.
So no more trying to figure out those cryptic allowance calculations.
Exactly.
No, that sounds good.
It definitely simplifies things.
Yeah.
However,
Okay.
it also means employers need to make sure they're using the correct withholding tables and formulas
Right.
based on the information.
Gotcha. So got to pay attention
Yes.
to the details.
You do.
And make sure our payroll systems are up to date.
Exactly.
Okay. And what about, so we talked about these new W-4s.
Yeah.
What about, those situations where the standard rules don't quite apply, like exempt employees or,
non-resident aliens.
Right, non-resident aliens.
There are specific instructions for those unique scenarios.
Okay.
For example,
Yeah.
exempt employees who are not subject to federal income tax withholding
Okay.
will typically need to file a W-4 claiming exempt status.
So even though they're exempt from withholding,
Right.
they still need to submit a W-4.
They do. It's all about
Okay.
proper documentation
Okay. Gotcha.
and making sure everything's recorded correctly.
It sounds like there's a lot to keep track of,
There is.
especially with all these, rules and exceptions. Any tips for staying organized?
One helpful tip is to
Create a checklist or a flow chart to guide you through the withholding process for different types of employees.
So like a visual aid.
Exactly. Can really simplify things.
That's a great idea.
And remember,
Yeah.
if you ever encounter a situation where you're unsure about the correct withholding procedures, don't hesitate to reach out to the IRS or a tax professional.
Good advice. It's always better to be safe than sorry,
It is. It is.
especially when it comes to the IRS.
Absolutely.
Okay. So we've covered a lot of ground already
We have.
in this
Big
deep
deal.
dive.
Yeah.
From decoding tax jargon
Right.
to understanding essential employer responsibilities
Yeah.
to navigating the intricacies of withholding.
Absolutely.
I feel much more informed.
Good.
What once?
Well, now that we've talked about those essential forms, let's dive a little deeper into the specific forms you'll need to have on your radar and what each one entails.
Okay. Sounds good to me. I'm ready to tackle those forms.
All right.
Head on.
Let's do it. Ready to untangle the web of IRS forms.
Bring it on. I'm starting to feel like a tax detective.
Right.
Ready to crack the case of Form 941.
Well, Form 941 is definitely a big one.
Okay.
It's your employer's quarterly federal tax return.
Okay.
And it's where you report all those federal income taxes, Social Security, Medicare taxes withheld from your employees' wages.
So it's like a quarterly report card.
Exactly.
For all our payroll tax obligations.
It is, and the due date depends on your deposit schedule.
Okay.
If you're a monthly depositor, it's due by the end of the month.
Okay.
Following the end of the quarter. But if you're a semi-weekly depositor,
right.
well, the deadlines get a little more intricate.
Tricky.
Often falling on a Wednesday or Friday, depending on when you paid wages.
See, this is where that look-back period and deposit schedule we talked about really come into play.
You got it. Yeah. Now, besides Form 941.
Okay. Another form you might encounter is Form 944.
944, okay.
This one's the annual employer's federal tax return.
Okay.
And it's filed once a year.
Okay, so that simplifies things a bit.
Right. It simplifies things for smaller employers.
Smaller employers, meaning like those with a lower tax liability.
That's right.
Okay, so how is that determined?
Good question.
Yeah.
If you expect to owe less than $1,000 in federal income tax, Social Security, and Medicare taxes for the year, you're usually eligible to file Form 944 instead of quarterly Form 941s.
Okay, so less paperwork.
Less paperwork.
Always a win.
Right.
Okay. And then we have Form 943.
Yes.
Which is specifically for agricultural employers.
That's right.
So this must be where we report all those special rules for farm workers.
Exactly.
That we talked about before.
This form covers Social Security and Medicare taxes withheld from farm workers' wages.
Okay, so we got Form 941 for quarterly taxes.
944 for smaller employers filing annually.
Right.
And 943 for those agricultural employers.
Yes.
Is there a common theme here? Are these all filed electronically?
They can be. The IRS encourages electronic filing for most of these forms. And oftentimes, you're required to file electronically if you have a certain number of employees.
Okay.
It's efficient.
Yeah.
It's secure.
Makes sense.
And it reduces errors.
Yeah. And then, of course, there's always that good old paper filing option.
Right.
For those who prefer the traditional approach.
Absolutely.
But speaking of errors.
Oh, yes.
What happens if we, totally mess up?
That's where those X forms come in.
Right.
941X, 944X, 943X.
Okay.
They allow you to make corrections to previously filed returns.
Always a relief to know there's a way to fix.
It is.
Those inevitable slip-ups.
Exactly.
Now, I'm curious about something else. W-2s.
Yes.
Those are a big deal.
Big deal.
For employees, especially come tax season. What are our responsibilities as employers?
So W-2s are crucial for employees to file their individual income tax returns. They detail their annual wages and the amount of taxes withheld. As an employer, you're required to provide W-2s to each of your employees by January 31st.
January 31st, that's
a hard deadline.
Hard deadline, no wiggle room there.
Correct.
Okay.
And you also need to file those W-2s with the Social Security Administration by the same date.
So W-2s, all about timely filing.
Timely filing.
For both our employees and the Social Security Administration.
Yes.
Okay, got it. Now, let's shift gears for a moment and talk about these unique scenarios we mentioned earlier.
Right.
What about situations where an employer is paying wages to their own children?
Oh.
Do different rules apply?
Great question. If your child is under 18 and working for your sole proprietorship or a partnership where you and your spouse are the only partners, their wages are not subject to Social Security.
So a little bit of a break.
A little break.
For family businesses.
Right.
But what if the child is over 18?
Once they turn 18, the rules change. Their wages would then be subject to those taxes just like any other employee.
So age plays a significant role.
It does.
In those family employment situations.
And speaking of specific situations, let's touch upon household employees.
Right, yeah. Nannies, housekeepers.
All of them.
Personal chefs. They're often treated differently. They are for tax purposes.
If you pay a household employee $2,600 or more in cash wages in a year, you're required to withhold and pay Social Security and Medicare taxes.
So $2,600, that's the threshold?
That's the threshold.
For triggering those employer responsibilities.
Yes.
And I'm guessing there's a whole separate set of rules for how to handle those taxes.
You bet. You'll need to use Schedule H.
Schedule H.
Household employment taxes. To report those wages and taxes on your Form 1040 U.S. individual income tax return.
All right. So Schedule H is the go-to form.
That's right.
For anyone employing household help.
Yeah, I'm starting to realize there's a specific form.
I know, right?
For almost every employment situation imaginable.
Yeah, it can feel overwhelming at first.
It can.
But there is a certain satisfaction in understanding how it all fits together.
There is. It's like solving a giant puzzle.
It is. It is.
Right.
All right, speaking of specific situations, I'm dying to know more about those motion picture project employers.
I know, right?
You mentioned...
It sounds intriguing.
It does sound very intriguing.
It's a unique corner of the tax world. Essentially, a motion picture project employer is someone who hires workers specifically for film, TV, or commercial projects.
Okay, that makes sense. But what makes their tax situation so unique?
Here's where it gets interesting. All the wages they pay to their workers during a calendar year are subject to a single Social Security tax wage base and a single FUTA tax wage base. Regardless of whether the worker is also employed by other companies during the year.
So it's like a self-contained tax bubble for that.
For sure. From the usual way things are handled, where the tax liability is tied to the individual worker's total income across all their employers.
That's fascinating.
Oh, right?
It seems like there's always something new to learn.
There is.
When it comes to employment taxes. But before we get too lost in the world of motion pictures, I want to circle back to a fundamental concept. Like what IS isn't considered taxable income. For employees, it can be a bit of a gray area.
You're right. There are some nuances to consider.
Yes. For example, let's say you give your employees a holiday gift basket.
Oh, okay.
Is that taxable?
That's a good question.
It feels like a gift.
It depends.
Not really compensation.
It does small non-cash gifts.
Okay.
Like a turkey or a ham for the holidays are generally considered
de minimis.
Fringe benefits.
It was de minimis.
It essentially means that the value is so small that it's impractical to keep track of for tax purposes.
So small, like...
But if you start giving out lavish gifts or cash bonuses...
Disguised as gifts.
Like, don't try to sneak a bonus. Ask the IRS under the guise of a gift basket.
You got it.
Okay, so those are no-nos. Right. Transparency is key.
Transparency is key.
Okay. Now, what about employee achievement awards?
Oh, okay.
Those are always nice to recognize, hard work and dedication. Are those considered taxable income?
That's where it gets a bit tricky.
Okay.
Cash awards or gift certificates are always taxable.
Okay.
But tangible awards, like a plaque or a trophy, might be exempt onto a certain amount.
Gotcha.
It's all about the details.
It's all about the details.
And staying within those IRS guidelines.
I'm sensing a theme here.
I think so.
Details matter.
Details matter.
When it comes to this stuff.
They do.
All right. What about things like employee stock options?
Stock options.
Yeah, those seem pretty common these days.
Yeah, they're a whole other world of tax complexities.
Oh, boy.
The tax treatment depends on whether they're qualified or non-qualified options.
Qualified versus non-qualified, it's like they have to pass a test.
They do.
Before they can be taxed.
In a way, they do.
Okay.
Qualified stock options have more favorable tax treatment.
Okay.
But there are stricter rules about when you can exercise them and how long you have to
hold on
stock. Yeah.
So more hoops to jump through.
More hoops.
But potentially bigger reward.
Bigger reward.
Okay, so it's all about understanding the trade-offs, right?
It is.
Okay, cool. What about educational assistance programs?
Oh.
I know some companies will help their employees pay for, college courses or professional development training.
Yeah.
Is that considered taxable income?
There's good news there.
Okay.
Up to $5,250.
Wow, that's a good amount.
In educational assistance.
Yeah.
Can be excluded from your employee's income.
Okay. Which means no taxes on that.
What a great way to encourage employees to invest in their education and skills.
Absolutely.
Okay.
But there are rules.
Right.
The education must be job related.
Okay, so no basket weaving classes.
No basket weaving classes.
Okay.
Unfortunately. Darn.
There goes my dream.
Sorry.
Of becoming a tax-deductible artisan.
Yeah. Okay, what about moving expenses?
Okay, what about moving expenses? Yeah.
I know those can be a big deal for employees.
Yeah, absolutely.
To relocate for work.
Yeah.
Moving expenses have seen some changes recently. For most employees, the deduction for qualified moving expenses is suspended.
Suspended until 2026.
Does that mean they're gone for good?
Not necessarily. It just means that for now, you can't deduct those expenses on your tax return. Unless you're a member of the U.S. Armed Forces on active duty who's moving because of a permanent change of station.
So a military exception.
Military exception.
To the rule. That's right.
Okay, so that makes sense.
Yeah, and even for military members, the exclusion only applies to reimbursement for expenses that they could have deducted if they had paid for them out of pocket.
So it's still tied to that suspended...
It's still tied to that suspended deduction. Not a free-for-all.
Not at all.
Gotcha.
The IRS has guidelines for what constitutes a deductible moving expense. Even for military members.
So whether it's gifts, awards, stock options, or moving expenses. The key takeaway is to understand those specific rules and guidelines to determine what is and isn't considered taxable income.
Absolutely. Clarity. And transparency are crucial.
When it comes to this stuff?
Speaking of clarity, I think it's time to demystify.
I agree.
Those third-party payers. PSPs. Reporting agents. CPEOs. It's a whole.
It is. It's a whole.
Alphabet soup.
Alphabet soup of acronyms.
Of acronyms, yes.
But don't worry, we'll break it down. We'll explain what each one means and how they impact your responsibilities.
I'm ready to dive into that alphabet soup.
Good.
Okay, so third-party payers.
Yes.
I have to admit, all this talk about third-party payers has me feeling a little lost.
Yeah.
Can we start by, clarifying what each type does?
Absolutely. Yeah, it's easy to get those acronyms mixed up.
Yeah.
Let's start with the most common one. Payroll service providers, or PSPs.
Okay, PSPS, those are the companies that basically handle all the, payroll processing and tax filings for you.
That's right. They can take care of everything from preparing paychecks, filing those tax forms we discussed, to actually making those federal tax deposits on your behalf.
Sounds pretty convenient.
Very convenient.
Does that mean I can just, hand over the reins and forget about all my tax responsibility?
Not quite. While a PSP can certainly lighten the load, you're still ultimately responsible as the employer for making sure those taxes are paid accurately and on time.
So it's more like they're an extension
of
my team.
Right.
Rather than a complete replacement for my role in handling taxes.
Exactly.
Okay, so it's crucial to choose a reputable PSP that you trust.
Absolutely.
And maintain open communication so you're both on the same page when it comes to compliance.
Exactly.
Okay, that makes sense. So what about those reporting agents?
Okay, so a reporting agent is actually a specific type of PSP with additional authorization. They can electronically sign and file certain forms on your behalf using your employer identification number, your EIN.
Okay, so they have a bit more authority.
A little more authority.
But again, I'm assuming the ultimate responsibility still lies.
You got it.
With me, the employer.
It's crucial to remember that. Regardless of which third-party payer you choose, you're ultimately accountable for those employment taxes.
Okay, noted. So we've covered PSPs and reporting agents.
Right.
What other players are in this?
So we also have agents authorized under Section 3504.
Section 3504.
Yeah. These agents are unique because they can pay wages to your employees, prepare and file tax returns, and make tax deposits, all using their own EIN.
Using their own EIN. That's quite different than PSPs and reporting agents.
That's right.
What are the implications of that?
So the key difference is liability. If the IRS designates a third-party payer under Section 3504, both the designated payer and the employer are held jointly liable.
So the responsibility is shared.
The responsibility is shared, yes.
Okay, that's a significant distinction.
It is.
From the other types of third-party payers we've talked about.
Absolutely.
Something to be aware of.
Definitely.
Okay. Any other types of third-party payers we should be...
One more, certified professional employer organizations.
Okay.
Or CPEOs.
CPEOs, yeah, I've thrown around a lot.
They're considered like the gold standard for third-party payers.
Okay. They're the ones with that special IRS certification, right?
That's right. They have to meet stringent requirements.
Yeah.
Go through a rigorous certification process.
So like the valedictorians?
You could say that.
Of the third-party payer world?
Uh-huh. And what sets them apart is that they're generally treated as the employer.
Hold on.
Yes.
If I use a CPEO, they're actually considered the
employer
for employment tax purposes.
Does that mean I'm completely off the hook? That's a great question.
For those taxes.
It is a great question, and this is where things get a little nuanced.
Oh, right.
While the CPEO assumes primary responsibility for those taxes, there are certain circumstances where you, as the client company, might still be held liable.
So even with a CPEO,
yes,
I can't completely wipe my hands clean.
It's always best to be aware of the potential liabilities.
Got it. Third-party payers can be helpful.
They can be.
But it's vital
to
understand the nuances of each type and the potential liabilities involved.
Exactly. It's all about making informed decisions that align with your company's needs and risk tolerance.
Now, while we're talking about, kind of the big picture, I can't help but think about how the very definition of, employment is changing these days.
Yeah.
With the rise of the gig economy and remote work. Those lines seem blurrier than ever.
You're hitting on a really crucial point.
Yeah.
The rise of the gig economy and the surge in remote work are absolutely challenging those traditional employee classifications.
Right.
And the tax code is playing catch up.
So let's start with the gig economy.
Okay.
Is it really that different?
It is.
From traditional employment when it comes to taxes?
It is. It's a common misconception that it's, just a different way of working. The tax implications are significant.
Okay.
Traditional employees have taxes withheld from their paychecks, but independent contractors, like those in the gig economy, are responsible for paying self-employment taxes.
Right. Those self-employment taxes can be a bit of a shock.
They can.
To this system, right? To those who are used to having taxes automatically withheld.
That's right.
So how do we even determine what factors does the IRS even consider when classifying someone as a work?
Well, the IRS uses a multi-factor test that takes into account behavioral control, financial control, and the relationship of the parties.
Can you break those down for me?
Absolutely.
What do they mean in, practical terms?
So behavioral control refers to the level of instruction and direction the company provides to the worker.
Okay.
Do they dictate when, where, and how the work is done?
Right.
Or does the worker have more autonomy and flexibility?
So if the company's, micromanaging every detail.
That's right. That's more indicative of an employee relationship.
Okay. Then there's financial control.
Financial control, right?
Does the company control?
Does the company control how the worker is paid? Whether they have to cover their own expenses?
Right.
Or if they have more financial...
Independence.
Independence, right.
Okay. So more financial independence leans towards
independent contractor.
Okay. What about that last factor, relationship of the parties?
So this delves into the nature of the agreement. Is there a written contract?
Okay.
What are the expectations regarding benefits, termination, the overall working relationship?
So it's not just about one single factor.
It's not.
It's about considering the whole...
It's about looking at the big picture.
Context.
Yeah, to determine the true nature of the relationship.
And this is an area where the IRS is paying very close attention.
They are, especially with the growing gig economy.
Because misclassifying workers can result in some pretty hefty...
penalties. Absolutely. If the IRS finds that a company has misclassified employees as independent contractors, they can face back taxes.
Oh, yeah.
Penalties.
Not good.
And interest.
Yikes. Definitely not a risk worth taking.
It's not.
So it sounds like seeking expert advice on worker classification is a wise move.
Couldn't agree more.
Now, shifting gears to remote work.
Okay.
Does that impact...
It can.
Worker classification.
It can, particularly when it comes to state income taxes and unemployment insurance.
Wait, working remotely could change an employee's state?
It's possible.
Max liability.
Some states have rules about nexus, meaning a connection or presence. An employee living in one state but working remotely for a company in another state could create a nexus for the company in the employee's state, potentially triggering.
So remote work adds yet another layer of complexity to this already intricate world of employment taxes.
It does. Companies need to be aware of these complexities as remote work arrangements become increasingly common.
It seems like the future of work is a moving target.
It is.
And we need to stay flexible and informed.
We do.
To navigate these evolving tax implications.
It's a dynamic landscape. And the key is to stay informed, seek expert advice, and adapt.
Well, this deep dive has been incredibly insightful.
It has been.
Before we wrap up, can you give us kind of a recap?
Of course.
Of the key takeaways for our listeners?
First, don't forget about those potentially valuable COVID-19 leave credits. Double check those eligibility requirements.
Always worth exploring.
You might be surprised.
Those opportunities for savings.
Next, those Social Security numbers need to be accurate. The SSNVS tool is your friend.
Absolutely.
Use it. Avoid those costly penalties.
And remember, wages go beyond just cash payments.
Yes.
Consider those fringe benefits and other forms of compensation when calculating payroll taxes.
Speaking of tricky calculations, make sure you're up to speed on those redesigned Form W-4s and how they impact withholding.
EFTPS.
Yes.
Game changer. For making those tax deposits efficiently and securely.
Absolutely.
Highly recommend getting on board with that.
I agree.
While technology can be helpful, it's crucial to understand your obligations.
It is.
As an employer, whether you're dealing with farm workers, household employees, or those unique motion picture project employers.
Yes.
And if you're feeling overwhelmed by all those forms and deadlines, don't hesitate to reach out for help.
That's right.
The IRS website is a great resource.
It is.
And a tax professional can provide personalized guidance.
Agreed.
And finally, keep those big picture questions in mind.
Yes.
The world of work is changing.
It is.
And so is the tax landscape.
Absolutely. So stay informed.
Stay informed.
Be adaptable.
And remember, we're all in this together.
Well said. Happy filing, everyone.
Happy filing.
And may the odds of a smooth tax season be ever in your favor.
This concludes our deep dive into the 2024 Employer Tax Guide. We hope you found this information valuable. Remember to consult with a tax professional for advice specific to your situation.